Good day.
Hello.
How are you?
I'm very good.
So let me introduce myself, John Corey, and I represent Property Fortress. I've been a property investor, US originally and then UK, so 35 or so years, 1983 in the US, Silicon Valley, moved across 94, bought some property after that in the UK, and we're here to talk about some property topics today.
And I'm Kwesi Afam, representing Slow Money. You would have heard John on my podcast probably in the past.
Maybe the first one.
The very first one, the inaugural episode. So you might have even seen John at the launch of the Slow Money events as well, held in Barclays. But I'm here to talk to you about my own property journey, being a property entrepreneur, an investor, and some of the challenges surrounding that. And so hopefully this is going to be a good discussion and people are going to enjoy it. But thank you.
Well, one thing I wanted to highlight today is I've been bouncing back and forth between the US and the UK this year. And that's included looking into how people raise money in the US versus how they do it here. And it's been an interesting contrast that the model for crowdfunding in the UK makes it much easier to put out an offer to see if there's interest. The US model requires a more stringent sign-off from the SEC. In fact, it's not even a sign-off for crowdfunding, it would be a sign-off for what is called a 506B or 506C registration.
Yeah.
So it's essentially a syndication. It's generally per project, just like most crowdfunding here in the UK. But I find the contrast between the FCA and the SEC quite interesting, or quite awkward at times, how one went one way, one went the other way.
Yeah, regulatory divergence is always an interesting theme. I think the UK, the regulator takes a different approach to this type of thing. Just kind of fundamentally, I think in the US, they look at it more from a conduct perspective, trying to be more controlling.
Yes, yeah, prescriptive, right.
More prescriptive. Whereas the FCA here tries to look more at what's going on and how it can support it. They do a lot of work here with innovation. They have a sandbox. They invite people in. They invite crowdfunding platforms in to try to look at how they can partner with these firms in order to be able to produce better products and services for the end consumer. So I think there's a different dynamic from a regulatory perspective. And you're right. The framework here in the UK around regulation, around financial promotion specifically, and around soliciting money and syndication of funds is very different, and there are some good avenues to raise money here quite easily. In fact, just the other day I was with one of the guys from Cedars, which is a platform that allows you to raise money in the form of equity. But then it offers two things there. It gives people the chance to be able to invest in startups, which kind of offers the opportunities that you might not get.
Yes, yeah, it throws the door open to essentially individuals who don't have a lot of capital, but they have made a personal judgment call that they're willing to put a little bit into the market in the hope that they could get some better returns, or that they can get in early in an investment that does well, fully recognizing that they could completely lose everything they put in.
But do you think that people actually appreciate that, though? Coming back to crowdfunding, do you think that people investing in this, because it's quite early in its life cycle, do you think people actually appreciate the risks that are involved when they're putting small sums of money, albeit, when they're putting into crowdfunding?
So if we want to get sort of metaphysical almost, human beings are not good at assessing risk. We're less at risk on a plane than we are walking down the street or on the pavement, and yet we think we're safer walking. So there's a lot of things we do that we don't understand the risk. So
that's true.
Investing won't be any different. I think the way I meant it wasn't so much that they appreciate the risk, but more that if they were going to spend £100 on a day at the Formula One, or a day at a restaurant, a nice restaurant with wine or some other expensive things, or they put £100 into an investment, that possibly means they could afford to spend the £100 and they won't be at risk. It doesn't mean they've done a good job of assessing the risk.
Yeah.
It just means they've somehow made a decision to spend the money.
Yes, I think, I guess another way to put what you just said is they have a capacity to bear the loss.
Yeah, that's a good way to put it. That, and again, sometimes people don't even think about that very well. Where if you ask them, "Can you afford to lose it?" Well, yeah, but you don't mean I'm going to lose it, do you?
Yeah, exactly.
Which is really rather telling that maybe they don't know that they could lose it.
Yeah.
And you can see this sometimes personally when if something happens, are you upset or frustrated, or are you rather sort of, oh, say la vie, there it goes.
Yeah.
You know, because you knew going in that it could be like that.
Yeah, and I think when people talk about risk, often one of the bits they don't, they might talk about their risk appetite. So they want the amount of risk they want to take on, but they don't necessarily talk about their risk composure, which is, sure, you want to take on that risk, but what do you do when that event happens? You might want to...
Interesting. Okay, tell me more about risk composure.
Yeah, so this is a really interesting theory that I've been thinking about a lot, actually, and I've been thinking about blogging about, so looked in the future, but the concept really here is that people, if there's a risk I want to take, let's take stocks and shares to begin with. Let's say there's an investment in a high-risk company, a property company. I might be willing to invest in it because I have an appetite for the risk. It's a risky investment. All my money's at risk.
Okay.
But what happens when the price falls 5%, or the price falls 10%, or the price falls 20%? Do I have the capacity or the composure to actually bear that risk? And then, because actually, you know what often happens...
it's easy to say it, but how are you going to behave? Okay.
When it actually happens, when the event materializes.
Yeah.
And so actually, it might be that it falls 20% and then it recovers and goes up 100%. But because of your lack of composure, you would have lost out on that opportunity because when it started falling, you sold.
So, to now go to the macro, classically when they study markets, professors who make these observations, retail investors get in late, they get out at the wrong time, they essentially almost, their decision-making process leads to even worse results than if they just had an index.
Yeah.
Which is why a lot of people are encouraged to just let the index do the work. Don't try to second guess it, don't make any decisions. Not only do you have the capacity and the time to do the research, so that's a big variable, but do you have the emotional fortitude to stick with your decisions? Now, one interesting one related to this is they talk about when you get into an investment, you need to have made a decision when you think you would exit.
Yeah.
So that you know in advance, and rather than emotionally reacting in the moment, you've already set out the criteria. If the criteria is met, you exit. If the criteria is not met, you don't. And you don't constantly react to your emotional state. But the funny part is there was also a great economist in Britain who said that that he changes his mind when he has new information.
Yes.
So, fundamentally, maybe your assessment when you got in was based on information. Now, if there's new facts, as an example, given sort of when this is being recorded, I was not a believer that Brexit would pass, and therefore I wasn't weighing that as a major variable. Once it did pass, it now becomes a lot more realistic, even though 3 years after it passing, we're still not out. But it becomes now something that's quite significant on the radar or part of the equation, and I wouldn't have weighed it up or put it in the equation before. So.
I mean, you mentioned the idea that when something happens or when events transpire, changing your viewpoint based on new information isn't necessarily a bad thing.
Yeah.
I don't necessarily know if people appreciate that as many people as they should.
Well, it's back to your, what did you call it, not appetite, but...
Composure.
Your composure. Is it really something new?
Yeah.
Or is it new just because you finally paid attention?
Yeah.
And therefore maybe you wouldn't have made the decision originally? Or is it really just emotional reaction and it's not actually significant or material, so it shouldn't change your decision, but emotionally you can't hang on. Yeah.
There's a gentleman called Greg Davies, actually. He's a behavioral economist. He used to be at Barclays, actually, but he runs his own company now, and he's done a lot of research in the space. And one of the interesting analogies he gives, so this isn't my own analogy, but I really like it. He gives the idea that actually you should have decision-making frameworks for finance. And so before you even make the investment, if you have a decision-making framework, you understand what your exit point is. beforehand. You don't wait. When events transpire around you, you always know how you're going to behave, because you put a framework in place around what you're going to do if it falls 5%, if it falls 10%, and that can help maintain that composure when events happen. And he said actually, it was an example that he gave. It may have been Ulysses. You might know this story, but it was Ulysses, the one who was a sailor who was on a ship, and so the song of the sirens would draw the ships into the mountains or into the
Right.
rocks. And so in order to avoid that happening to him, but to be able to enjoy the sound of the sirens, he asked his crew to tie him to the mast of the ship
Yes.
while they put wax in their own ears. So they couldn't hear it, so they could sail the ship. He could hear it, but he couldn't move because he
Yeah,
was tied to
yeah,
the mast.
yeah.
And so in this way, there's two frameworks there. One which allows the ship to pass without being drawn into the rocks. Another which allows him to hear the music without, behaving as he wouldn't want to. And,
So that, in a sense, there's a context.
yeah.
So if we pull this into property, one of the things people talk about is, are we going to have a recession, or prices going to fall, or name a hot market or a hot spot. And I tend to, partially to be contrarian, but partially I say, well, it doesn't matter. First of all, you cannot realistically buy the market. You buy one property.
Yep.
And if you get a good deal on that one property, it doesn't matter what the rest of the market's doing, you still have a good deal. And if you're buying 20% below the market and the market corrects by 10%, you're still in profit. Now, flip it around. If you're buying a property for a very long hold, I think the tenant demand and the rent levels is more important than what the pricing is at this stage.
Yeah.
So while you need to focus on cash flow and yield and all the other things as almost window dressing, the fundamental drivers are going to be the demographics. Is the population increasing or decreasing? Do people have jobs? Those jobs increasing or decreasing in demand and pay scales? The long-term value of that. So if you buy a property that never goes up and you own it for 30 years, and you put it on a repayment loan, which I know most Brits would go, oh my God, you don't do that. Okay, but it's on a repayment loan over 30 years. At the end of 30 years, you own a free and clear asset with no debt, and the tenants paid it off over the 30 years, plus paid you enough to maintain it if you bought it in the cash flows, okay? So I don't care if it doesn't appreciate,
Yeah.
because now I have an asset free and clear. That's still gonna produce an income, or I could sell. If it does appreciate, that's just extra.
I think that's one way to look at it. A lot of people, especially if you're in London, they focus on London because they think that there's appreciation. They don't necessarily look at what you just said, the other way around, which is reducing the debt. People often look at equity being created because of market appreciation. They don't necessarily look at creating equity for themselves, either by paying the debt down or by adding some kind of value.
Well,
So that's a good
there's
point.
3 ways that equity could happen.
Yeah.
One is you take an existing asset and you improve it.
Yep.
So you somehow make
Taking
it better.
impaired. Yeah. Impaired asset and.
Yeah, could be impaired as in damaged, or it could be it's a 2-bed and it really could easily be a 3-bed.
Yep.
So you've improved its value. Second is you can create equity as you highlighted by the debt being reduced. So, and particularly if a third party is paying the debt off the tenant, all they want is flexible occupancy.
Yep.
So they're looking for a roof over their head on terms that don't commit them forever. And as long as you're willing to rotate the tenancy to the next tenant, then you can have it paid off over a period of time. And the third is appreciation, which can mean one of 2 things. It could either mean greater demand with the supply that's not keeping up, so people are willing to bid up the price. There's a limit to how much people can afford to bid up the price. The other one is inflation. And classically, that's more tied to the inflation rate that the government's set out, but also therefore wages. So why do people pay more in the future years? Well, because the wages went up because of inflation. So it's a bit of a circle. The interesting thing with inflation is, did the building get more valuable, or did the currency shrink in value? So it takes more of the currency to buy the same building.
Yeah, and I think if you look at that, obviously governments tend to deflate their currency in order to be able to.
Well, they want positive inflation, and the reason they do is because people like to think that next year they're going to get a raise, and they don't like this idea that they'll always be earning the same amount for 30, 40 years
Yeah.
unless they up their skills. So it's a positive way of dealing with society, both businesses and individuals, to have a slight positive inflation rate rather than a slight flat or negative deflation.
Yeah.
So it works slightly better with positive inflation, but that will cause people to say, oh, but then the money's being deflated.
Yeah, but you can't have your cake and eat it, which is a challenge.
Yeah.
And again, bringing it back to property, I think looking at the inflation challenge, especially with the current environment that we're in, the main impact there, we're looking at finance. So if you are financing your property deals, then inflation there could impact the interest rate that you're paying. The availability of funds could be a factor as well, I think, looking down the line. The other element that you mentioned in terms of the demand supply dynamics is interesting as well, because we have, in the UK at least, well, in London at least, the demand supply dynamics are very different to the rest of the UK. So again, looking at your point, you may be able to find property outside of London which doesn't appreciate, but has great demand supply dynamics from a rental perspective. So occupancy is always 100%. Whereas in London, you might find somewhere where there's investors, so there's the demand to buy and acquire and hold as an investment, but the demand for living there has fallen away. Maybe the local area is changing, the dynamics are there. So to your point, I think there's a lot of things to consider beyond just what somebody might look at in terms of the economics of the market, Brexit, any of the broader macro elements that we need to consider.
So one of the things I like to say is that if you can find a motivated seller, you can possibly do a better deal, but you have to be able to solve the seller's problem.
Yep.
Now, there's a company I'm a non-exec director for, which has an algorithm that identifies motivated sellers before the properties become under distress.
That's interesting. So how do they do that? What type of inputs and factors do they
Well,
consider?
it's a bit of a black box that I can't go into.
Okay.
But essentially, there are a lot of things in life. There are early signs, very similar to artificial intelligence, being able to spot patients that are going to have a kidney problem 2 days quicker with the app than the doctor would spot it, because they can detect things. And very similar to when there's a flu outbreak, Google can tell 3 weeks before the flu outbreak is confirmed, because they can see us start drifting up in the searches of flu symptoms.
Yeah. So it's interesting.
when you have better information now, to make this organic, and if anyone wants to know about the company, they can get in touch. But fundamentally, demographics are a really easy thing to get a hold of. You know, the governments do census reports.
Yeah.
Pretty much everybody that's going to want a house 20 years from now was born by now.
Yeah.
You know, you get this sort of, by the time they become an adult, so unless they're moving in from some other area, and you can see when they're moving in from some other area too. So a lot of the data is there to understand the demographics.
Yeah.
A lot of the data is there to understand the employment trends. You can't necessarily predict when a particular factory will open or close, but you can see growth or contraction in sectors. So for rental demand, you can do a lot of the fundamental research quite easily with no real cost.
Yeah, I mean, without even having to get into the algorithm and having to use the kind of technology element of it, there's basic stuff you can do, like looking at where government investment is going.
Yeah,
If
infrastructure.
Infrastructure projects, they're looking to set up any particular type of hubs in certain areas to attract certain types of skill sets into that area. You can be sure
Well,
that...
even if you don't look for hubs, because possibly hubs are a sophisticated concept, but are they opening a new train station? Are they putting a new interchange for the motorway? Are they upgrading the train line so there's better service, faster service, or lower cost, whatever?
Yeah.
Adding a runway. These tend to cause ripples in the economy that last for 30, 40 years. That is a very long time. If you have a 30-year loan that you're going to pay off in over 30 years, and this is a 40-year impact from the infrastructure, you're probably going to be reasonably safe that there'll be new demand in the area.
And actually, just coming back to inflation, that's the other point. If you're looking at it over a 30-year period, deflation of that debt is a factor that, again, people don't consider.
The debt of melt.
Yeah, relative to the appreciating inflationary effect on the house price. So, yeah, I think just in terms of whether people always ask me the question, is now a good time to invest? My answer is always, now is better than yesterday, and now is better than tomorrow.
Well, a different version, which is an old one that I've heard a long time. The best time to invest was 5 years ago.
Yeah, which you can't do.
And you can't do that. So then the second best time is now.
Mm.
So that in 5 years' time.
Yeah.
So the key here is you have to believe that you're going to be alive, or that you're going to hand it on to someone you care about. And second is that in 5 years' time, you don't want to be looking back and saying, I should have invested, right? Can you invest now and get someone else to pay the carry cost?
Yeah.
So the cost of owning it for the 5 years, if someone else is willing to cover all those costs, why wouldn't you invest?
So on that, actually, one of the things I always look at is why do people sell? So if people say, well, 5 years time, I should have invested, or it's appreciating, I always wonder why people don't do more to build portfolios as opposed to trade or sell. And
So if we're talking about owner-occupiers,
no, I mean from an investment perspective. So like for me personally, my model is infinite holding period.
okay,
And I
so
think
then you don't care about the market because you're going to hold forever.
that's this is how for me I get over the market element in terms of smoothing it out from my investment portfolio.
So you're either kidding yourself, talking yourself into something, or you are actually onto something.
Okay, which one is it? Let's discuss. But for me personally, I mean, the way that I actually came about this assessment, I looked at a lot of investors, a lot of people who have acquired generational wealth, and where often
The gray hair types.
the gray hair types, and even the children of the gray hair types who now have gray hair. How did and where often they make their money outside of property, funny enough, is one of the key things.
Creating wealth is classically done in business,
Yeah.
and then real estate properties used to maintain wealth.
And so that was the interesting idea to me, which is that actually if I'm gonna try to invest, I need to take the approach that they've taken in order to hold their wealth, as opposed to trading away that compound gain that they've got over time.
So follow what's worked.
Follow what's worked.
Yeah.
Follow what's worked. And for me, clearly what's worked. If you look at, I don't know, take Regent's Park or whatever, and who owns most of the real estate there? How long have they held it for? What is the long-term appreciation value of all of that? And Crown
So
Estates.
when you hold it very long term, you almost don't care about the appreciation. It's all about the cash flow.
Exactly.
Because that's what keeps you in the game.
Yeah.
That's what allows you to benefit today from what's happening today.
Yeah.
Because in a sense, other than if you sell or other than if you refinance, that appreciation value isn't really there.
No.
You know, it's
Yeah.
in theory, but till you have a way to tap into it, it's all about the cash flow.
Exactly.
But I do want to highlight something different, which is related. So when you have your thinking clear, then part of the job is sharing that information with others.
Mhm.
Because you can grow a portfolio if you can bring in capital from other people
Yes.
who don't have the time, the energy, whatever. They have a busy life some other way, and they're happy to piggyback off of or follow or mirror what you're doing. And this is coming back to the regulation, whether it's US syndications or UK crowdfunding, you can actually legally raise money from others that you can then put into assets that you manage, that you cash flow, and share that wealth and have more buying power. And then we're back to the other question though, is now you have multiple investors and each one of them is going to say, well, I have things going on in my life. I need the money back, or I want to get some of it back,
Yeah.
or whatever. I don't necessarily want to do 10 generations. So they worry about liquidity
Mm-hmm.
and how to access their capital, which they've put into the pot with you.
Yeah, and the liquidity challenge, I guess, is probably one of the ways that crowdfunding platforms, and even, I guess, if we project into the future, you have things like the blockchain, and you have different ways that you can tokenize assets.
Yeah.
You can take a physical asset and digitize it. And when I talk about digitizing is different to digital. I'm not talking just about scanning a piece of paper and having a PDF digital version of it. I'm talking about taking title deeds and creating a blockchain representation of it.
Well, the deed is the blockchain entry.
The deed becomes a blockchain entry, so it's an actual digital
It's
manifestation.
not the inside of a sheepskin written on.
No, and it's a physical manifestation as opposed to a digital manifestation as opposed to a physical one that you see on a digital tool. So yeah, the digital aspect of that, once that enters into the property space, is going to make the whole thing
So
quite interesting.
let's pause that for 1 second. You recently shared some information the FCA published. It was the policy statement on cryptocurrencies or crypto assets. So I know one of the things that was in the consultation is they've broken the assets into 3 categories. Can we go a little bit into what the big insight is from the policy statement?
I think for me anyway, the main thing is that they continue to. I think let me go back. A lot of people, when they look at the crypto assets, they're really talking about Bitcoin. So there are various crypto assets out there, and they're all regulated in different ways.
So that's just one crypto asset.
That's just one crypto asset, but actually, from my experience, 90% of the interest represents that particular crypto asset. And what was interesting for me in particular about the FCA policy was the fact that they effectively defined the regulatory framework looking after blockchain exchanges, and all of this space. And I think the message that I want to convey and make sure people are aware of is that it continues to be, for those assets that you don't receive protection from the FCA on. The exchanges that hold those assets may or may not have insurance to cover the losses of what they, even if they do have insurance, whether that insured amount covers the full amount of the exchange value, something that people should be considering. And in particular, when it comes to ICOs or initial coin offerings, the information or the documentation that you review, you need to look at that very carefully, because none of that complies with any of the FCA rules. So I think for me that was the key thing. Then there's a whole separate element of crypto assets which you may or may not have some element of protection from FCA from. They don't cover things like the financial services compensation scheme. So 80 grand, if you have that in a bank account and the bank goes bust, you get that back. That's not covered by these crypto assets. What you can do is the FCA will pursue the legal entity that is responsible for this, etc. So
the important point I wanted to highlight is anybody who's doing an ICO or anyone else who's trading in security tokens, those are regulated by the FCA.
Security tokens are definitely regulated. Currency is unregulated, and the utility to coins are unregulated as well. So historically, a lot of people have been presenting their crypto security coins as utility tokens, and that was one of the reasons why the FCA started this consultation.
So that people really hear this. So all those promotions people have seen in the past, where you're getting a piece of a company or a piece of a deal, and you're going to make a profit because we're going to grow this monster company, those are shares, those are security tokens, and those are fully regulated, even though people didn't think they were.
Yeah, exactly. So yeah, that's the interesting point you make. What's the difference between a utility and a security? And so the utility is something that gives you an element of return relating to an activity or an action, or
so like a benefit in kind.
And like a benefit in
or
kind.
Access to the concert.
Yeah. So I met some people actually who wanted to start a blockchain-based mobile network. And so you buy into it, but your utility is that you have access to the network.
Yeah.
And that's not a security coin, that's a utility token. On the flip side, you can have people who do an ICO, and they issue you with tokens, which you can then trade on an exchange in order to make money, or you get a cash return of some sort based on the activity of that company. That's security. And so, yeah, and I think that's...
So if I have a property, piece of real estate, it's in London or it's in Oxford or Bristol, whatever, up in Scotland, over in Wales, Northern Ireland, doesn't matter, and I sell tokens, which are shares of the property, then that's a regulated activity.
Yeah, they're going to be getting a return based on the performance of that property, then that's going to be regulated activity, that's security.